Welcome to our 6-minute strategy from me, Guy Munson at Saracen & Partners. This week I've called the episode A Time to Sit on the Fence. We have our quarterly investment meetings next week, and our job will be to interpret some very contradictory messages from the global economy. On the plus side, labour growth remains remarkably strong. Surveys of the US service sector are ahead of almost every forecaster, and we have the prospect of a reopening in China, which could be really quite rapid. This good news, though, ironically, seems to have spooked markets. The S&P 500 has actually declined every day in December. Investors, it seems, fear a Federal Reserve that will have to work even harder to drive inflation back to target. By contrast, there are clear signs too of a quite rapid economic slowdown. The US yield curve is at its most inverted in 40 years, a near sure sign of a recession to come. Oil prices are actually lower than they were at the beginning of 2022, despite the war in Ukraine, extraordinary. Industrial commodity prices are falling, and house prices in the US and UK are beginning to stall. Recession risk, it seems, continues to rise. So which is it to be, a coming global recession or a labour market that refuses to slow? We'll look at the possible asset allocation implications in the slides ahead. So let's begin by looking at our regular chart of the performance of world markets for the year to date. And you can see that sharp rally in global equities in dark blue that occurred at the beginning of Q4 is starting to fade. What's causing this sell-off in risk assets? Well, in my view, an inversion of the US yield curve to almost record levels last seen back in the Volcker days of the 1980s. Why is this important? Well, the difference between the US 10-year and 2-year is a remarkably good indicator of recession in the US and global markets to come. You can see that every time that dark blue line goes negative, it precedes one of those yellow bars, a US recession. So that's the outlook for today. What's the outlook longer term? Well, our view is that with that backdrop, the US Federal Reserve will succeed in slowing inflation. We see the CPI coming down from 8.1% in 2022 to 3.7% in 2023 and settling somewhere around 2.7 to 3% in 2024 and beyond. What's causing this over the long term? Well, probably the end of what we call the Great Moderation, that period of ample global labour from the emerging markets, supply chains stretched out across the world, and new technology. And that allowed inflation to fall steadily over those blocks of periods that I've shown in that right-hand bar, from 5.8% down to almost 1.6% in the 2010s to 20s. What's the position today? Well, the world is changing. Demographics mean an older population. COVID has a long-term hangover for health provision. Deglobalization is becoming an issue, harsher geopolitics, and of course the long-term challenge of climate change. All those argue that that long-term inflationary number will drift up from the 2% inflation target that central banks would like to achieve to, as I said, somewhere around 3%. But the journey there is not going to be straightforward. And if you're Chairman Powell at the Federal Reserve, you worry first about the labour market. It's still remarkably tight. I've shown the left-hand panel labour demand, that's employment plus job openings at 169 million, well ahead of labour supply at 1.64 million. And in the right-hand panel, you can see on 3 measures there, that's pushing up US measures of average wage growth to between 5 and 6%. And that's simply not consistent with the 2% inflation target. And here in the UK, of course, is pushing extreme industrial action. So to get there, I'm afraid we're going to have to see unemployment rise. We expect to see that number climb from somewhere around 3.7% to 5% to begin to ease that long-term inflation pressure. But it's a rocky road. The second challenge the Fed is facing is that it wants tighter monetary condition to begin to slow those demand numbers and take that inflation off. That means tightening financial conditions. The Financial Conditions Index in the left-hand panel shows indications like bond yields, stock market levels, bond spreads, and credit availability to give some idea of the tightness of policy. Now, the Fed moved dramatically in 2021 to tighten policy. That moved in the direction they wanted. But look in the last 2 or 3 months, with rallying stock markets and rallying bond markets, that's begun to ease, making the Fed's job more difficult. On the right-hand panel, the indications are they can still get there. 5-year inflation expectations, that's where investors see inflation in 5 years' time, holding steady at around about 3.8%, but the volatility of those numbers rising which means more uncertainty and more precautionary demand for wage demands to guard against rising prices in the years ahead. Thirdly and finally, there's a rogue element in all of this, and that's the remarkable moves in oil prices. So far, they're very helpful for Jerome Powell. They're actually lower, you can see that chart of Brent and WTI, the red and blue lines, than they were at the beginning of the year. Extraordinary given the horrific conflict in Ukraine. The real pressure, though, has been on Russian oil prices, and you can see that remarkable collapse in the Urals blend, which measures some indication of global Russian oil prices, down at 47.5. Now that's going to be capped, and I know the level is a lot above, at $60 as we heard this week, given the forceful intervention from G7 and the Europeans, who will withdraw services and insurance for all Russian oil sold above $60. On the right-hand panel, you see that's going to hurt Russia long term. $60 is well below the average Brent price of $71.50. All this combining together to cause a weak oil price and severe problems for the Russian economy. So what does this mean to wrap it all up for global equities and bonds? Well, the left-hand panel, I've shown the one-year forward earnings per share growth rate. And extraordinarily, bottom-up earnings are still quite robust, climbing at 13.5%, supported by strong sales growth. So we're not seeing Armageddon yet in any way in US and global corporate earnings. The pressure, of course, will come on the right. These record margins will decline as input costs rise, and quite rightly, labour demand more share of the pie. So where does that leave us overall? We're taking the easy stance at this point. We're remaining neutral corporate bonds and neutral global equities to guard against either of these outcomes: a tighter global labour market which forces higher interest rates, or a sharper slowdown that forecasts a deeper recession. With our thematic equity selection, we hope this can protect us against earnings downgrades, and with some of the yields today in UK and global corporate bonds, there's a useful long-term real inflation pickup. Well, I hope that's helpful. Thank you.